Drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
Hello students, welcome to irrepeatable.com, your online gateway to the world of invaluable knowledge. So, during our last discussion, we were trying to understand the concept of risk-free rate of return and risk premium, and we tried to understand it with the help of a simple example wherein we found that there is one person, Mr. X, who has been provided with two options. The first one being either he should park his 10,000 USD with a bank FD for 3 years, fetching him a return of 10% per annum, and secondly, he has been provided with an option of investing 10,000 into his own business venture. So as per the definition or the discussion on the risk-free rate of return and risk premium it went, we found that the risk-free rate of return in this particular case was a 10% interest return on the FD deposit of 10,000 USD for the next 3 years, which Mr. X would have earned without taking any hassles, without taking any stress regarding any sort of default whatsoever. But the moment he chooses to move out from his comfort zone and venture into the world of business, we found that he was likely to be surrounded with a number of risks like market risk, liquidity risk, technological risk, operational risk, geopolitical risk, etc., etc. And in order to make himself hedged against, or in order to cover himself against all those risks, it was very right on his part to ask for a risk premium from his business. So his total RS, or required rate of return from his security, would be the 10% risk-free rate of return, or the opportunity cost which his business was supposed to return to him. And secondly, the risk premium depending upon the perception Mr. X was having towards the futuristic risks. So if the perceptions regarding the risk was high, if Mr. X comprehended that the risks which are going to be associated with his business venture are high, he shall be putting a higher risk premium, and if he comprehends a lesser degree of risk, then the risk premium as computed by him shall be of a lower nature. So for example, if Mr. X puts a risk premium of 12%, against the assessment of the risks, based on the assessment of the risk which he has made from his venture, then his total required rate of return shall be 10% plus 12%, that is 22%. So it is a very simple example, it is a very naive one to see that suppose Mr. X, after comprehending the nature of the risk, after comprehending the intensity of the risks which are going to be associated with his business venture up and above the risk-free rate of return, he chooses to put a premium of 12% on the risk, then his total required rate of return shall be 10%, that is the risk-free rate of return, and 12%, that is the risk premium, thereby taking his overall RS, or required rate of return, from his venture up to 22%. So it means, in effect, what does it mean? In effect, it means, students, that in any case his business should yield him a return of more than equal to 22%. In any case, the business venture should yield a return of more than equal to 22% to Mr. X. It means that at any point of time, his return should not fall below 22%. At any point of time, his return from his business, or expected return from his business, should not fall below 22%. It should be rather more than equal to his 22%, which comprises of two parts. Once again, 10% his risk-free return from his bank FD, and 12% as a risk premium based upon his perception regarding the futuristic risk associated with his business. Now, a pertinent question arises that how to calculate the RS, or the required rate of return from a security, or a required rate of return from any asset, whether it is a financial security, whether it is a house property, whether it is a business in the real world. So there should be some statistical tool based upon which the required rate of return in the real world should be calculated, because we all know that the calculation of risk-free rate of return does not pose much of a challenge. The calculation of the estimation of the risk-free rate of return can easily be made from the existing government bonds, the gilt securities, the bank FD rates, depending upon the tenure for which the business is being taken up, or a particular asset is being invested into. But what about the risk premium? The risk premium should not be whimsically put, because putting a excessively higher risk premium is a matter of an over-conservatism, and higher RS, or a higher required rate of return from a security or from a business, by putting a higher premium shall be putting an undue pressure on the assets to perform. So the entire RS based on the RF as well as the RP, it should be backed more by rational, it should be more logical rather than whimsical about that. So in the real world, a CAPM model, a statistical worldwide famous model, which is being extensively used by managers, known as a CAPM model, it is being used to calculate the RS, or the required rate of return from a security. The CAPM model stands for the capital asset pricing model. The capital asset pricing model in effect says it highlights the required rate of return from a security as anticipated by an investor based upon the risk-free rate of return and the riskiness which is being shown by RP, or the risk premium. So the CAPM model does a commendable job in predicting or in assessing the risk premium which should be put by the investor up and above the RF. So you can see that the formula for the CAPM model, the formula for calculating RS through the CAPM model is RF plus beta times the excess of RM over RF. Once again, I repeat, students, just take a careful look, take a close look at the formula. The formula says that as per the CAPM model, the RS, or the required rate of return from a security, is equal to the RF plus beta times, within bracket, the excess of RM over RF. So let's take a closer look at the second part of the equation, that is a beta times excess return of your RM over the RF. We are well conversant with the RF part, that RF stands for the risk-free rate of return. So this beta times excess of RM minus RF represents the second part of the equation, that is the RP, or the risk premium. So in effect, we can say that the risk premium has been denoted by the beta times the excess of RM over the RF, that is the return from the market over the risk-free rate of return. Now, what is this beta? Beta is a statistical tool. Beta is a statistical indicator which denotes the systematic risk. Beta always studies the systematic risk. Now, what is systematic risk? Systematic risk refers to those risks which are inherent with any decision with the entire business environment. So no matter how much diversification an investor is trying to, no matter how hard a manager is trying, systematic risks are always going to be there. So suppose some sudden change in the government policy which is affecting the entire broad market, certain macroeconomic risks, so certain risks which are coming from your overseas market. So no matter how hard strategies we are making, so how hard a business manager is trying, there are certain risks which cannot be hedged against, there are certain risks which cannot be escaped. So the beta studies the systematic risk, and on the other hand, unsystematic risks refer to those risks which can be hedged against, or which can be tackled by diversifying our portfolios. Now, a higher beta denotes the higher risk which is entrenched into the asset class. Over here, when we're using the word asset class, this asset class can be any asset class. It can be your financial security, it can be your stocks and bonds, it can be your house property, it can be overall business. So in effect, it means that higher the beta, higher the systematic risk, and higher beta denotes a higher degree of the risk or systematic risk which is entrenched into the particular asset class. So the moment we are moving ahead from our safe zone, the moment we are moving ahead from the comfort zone of risk-free rate of return, we have to expose ourselves to the beta. So it means that the tone and tenor of the beta or the systematic risk may be high or may be less, but it will never be zero. So no matter how hard we try, no matter how foolproof we try to make our strategies, the systematic risk is always going to be there. It cannot be escaped in full. Now, the term within the parenthesis RM minus RF refers to the excess of the average returns from the market over and above the risk-free rate of return. So when we're taking the when we're using the word risk-free return, obviously it means that when a business enterprise or an entrepreneur is trying to venture out from his risky zone, obviously it means what? He is trying to get a return which is more than his risk-free rate of return. So I once again repeat myself, students, when a entrepreneur or when any investor is trying to move out of his risk-free rate of return, a pertinent question arises that why exactly he is trying to move out from his risk-free rate of return when he is safe and happy over there. So as I said, some people, they love taking the risk, while in order to earn a higher degree of return, a higher degree of risk has to be taken. Okay, risk-free rate of return is giving us a return, but suppose if we wish to add a flair, if we wish to increase the return up and above the risk-free rate of return, it invariably means that we need to venture out from the risk-free zone to a riskier zone. The moment we are moving into a riskier zone, it means that somewhere back at the back of the mind, we are trying to earn a return which is higher than the risk-free rate of return. So the market return, which is up and above the risk-free return, is being denoted by the return from the average market minus risk-free rate of return. It is the how much return the broad market is generating for the investor, for the entrepreneur, which is up and above the risk-free return which he is getting. But over here, the word of caution is that it is not merely the RM over the RF which is worth taking into consideration. It has the excess return of your market, of the average market over the risk-free rate of return, has to be studied in the light of the beta factor, or in light of the riskiness which has to be borne, which has to be taken into consideration in order to earn a higher return from the market, higher from the average market up and above the risk-free rate of return. So try to understand this point very clearly. It is not only the excess of the return from the market over the risk-free rate of return which should be taken into consideration. Rather, it should be seen into the light. The excess of the average market return over the risk-free rate of return should be studied into the light of the beta factor. It means if there is a higher beta factor, it simply means that in order to earn that excess return from the market over the risk-free rate of return, a higher degree of risk is being taken up, which is being shown by a higher beta. On the other hand, if the beta is moderate, if the beta is low, then we can see that the excess return of from the average market over the risk-free rate of return is being enjoyed, or it can be enjoyed against a lower degree of the systematic risk which are inherent with the business decision. So higher beta coupled with a higher return from the market up and above the risk-free rate of return will invariably lead to a higher risk premium. So it simply means that if an investor is looking forward to earn a return, market return, which is higher than the risk-free rate of return, and for for earning that excess return he has to pay a higher beta, it means that he has to ask for, or very rightfully he should be asking for a higher risk premium up and above the risk-free rate of return, which will decide the course of his required rate of return from the particular security or the asset. So the risk is studied under the beta factor. Higher market return over the risk-free rate of return coupled with a higher beta shall increase the overall risk premium. On the contrary, if the return is high over the risk-free rate of return, but the beta factor or the beta or the metric for the systematic risk is lower, it means that the business shall be putting a lower risk premium up and above his risk-free rate of return in order to compute the overall RS, or the required rate of return from the security. So this is just a outline, or this is just a lemanish discussion regarding the beta. We have just touched it across, but the Capm model, the actual beta factor computation shall be taken into detail when we shall be discussing the chapters like capital budgeting, cost of capital, etc. But as of now, we should again just keep in mind that the required rate of return from the security should be studied in the light of the risk-free rate of return and the risk premium, which is being computed as a function of the higher average market return over the risk-free return coupled with the beta metric or the beta factor. So if the beta factor is high, it really means that a systematic risk is high, which should lead to and demand of a higher risk premium from a particular asset up and above the risk-free rate of the return. Now let's take a very simple illustration to make the concept even more lucid. Now suppose the variables which we are having at our disposal is the risk-free rate of return is 10%, the return from the broad market is 18%, and the beta factor is 1.6. So, and one thing students, ideal beta factor is 1. If something is going above 1, it means it is a high beta, the riskiness is high. If something is falling below 1, it means that and if the beta is less than 1, it means that the overall riskiness or systematic riskiness of a business firm or of any venture or any asset is comparatively less. So when you find that the beta factor is 1.6, it means that the excess return from the market, that is the 18% minus 10%, 8%. In order to earn the excess return of 8%, the firm has to take into consideration the riskiness to the extent of 1.6 beta. It means that the formula works out like RS is equal to RF plus beta times within bracket RM minus RF, the excess of your RM, excess return of the broad market over the risk-free rate of return. So we can see that the RS works out to be 10% as a risk-free rate of return plus 1.6 at the beta factor over 0.18 minus 0.10. That is 10% of 10% is the risk rate of return, and in order to earn an excess of the return from the market over the risk rate, that is 8%, the firm has to withstand a riskiness, systematic riskiness, which has been denoted by a high beta, that is a 1.6. So which invariably leads to ask an overall return of 22.8%, or nearly it is approximately 23% as an RS. So if a person is investing into a particular stock or into a particular asset or into a particular long-term business venture, under these conditions of 10% risk-free rate of return and 18% RF with a beta factor 1.6, the total RS for the required rate of return from a particular security or a capital asset shall work out to be 22.8% or 23%, that is quite high. Okay students, in the successive slides we shall be discussing compounding. Thank you students.